Most trading advice sounds safe, sensible, predictable, but Tom Hougaard doesn't trade that way, and he doesn't think like 90% of traders. In this video, we're diving into the mindset and intensity of one of the most controversial and brutally honest voices in trading today. With decades of institutional screen time, Tom built an approach that thrives on discomfort, aggressive scaling, and relentless psychological pressure. We've selected 7 of his most raw and revealing clips, pulled directly from the ComLucro archive, to explore what separates high performers from the crowd. This video is split into 4 parts: core philosophies, emotional blind spots, trading behavior, and the performance mindset that drives results. Let's begin with a concept Tom invented himself, one that defines how he prepares for every trading session.
Let me give you an idea of the kind of technical analysis that I deploy. I think the odds are high you'll never have heard of that kind of technical analysis. So let me give you a sample of the kind of preparation I do ahead of a trading day. Say for the sake of the argument that it is Sunday night and I'm preparing for trading on Monday. I have developed a technical analysis that I call scenario analysis. Scenario analysis is something I invented myself. I have never heard anyone discuss it, talk it, use it. Let me give you an idea of what I mean by scenario analysis. Imagine the scenario in the Dow Jones Index, or it could have been anything that I have researched. Say the scenario is Friday's trading was unable to trade above the highs on Thursday. So as you observe over the weekend, how did the market trade on Friday versus how was it trading on Thursday? And if during Friday the Dow was unable to get above the highest point that we saw on Thursday, it has severe ramifications for what you can expect on the Monday. My research suggests that there is a 95% chance that during Monday, the Dow will trade down to the lows seen on Friday, and in most cases will trade lower. Now, what is that statistics based on? This is based on manual analysis of the Dow Jones on charts spanning back from 2008 until 2019. Off the top of my head, over the last year, there has been 24 occurrences where before I went into the trading session on Monday, could observe that the Dow was unable during Friday's trading session to trade above the highs of Thursday. And out of those 24 occurrences, in 21 of those 24 occurrences, the market traded below the lows of the Friday. Now, is that data crunching? Is it technical analysis? I don't know, call it what you want.
That mindset flips the conventional logic of risk. Most traders think in terms of safety. Tom thinks in terms of pressure. The ability to stay with a winning position, even when it's uncomfortable, is what separates average trades from transformative ones. Now, let's go deeper into that discomfort, because it's not just about holding winners, it's about pushing them.
No, I prefer to buy high and sell even higher, and I sure do like to sell short low and cover even lower. So, Charlie D goes on to say that it's in our human nature to want to cut our winnings. You bought at 6 and you can get out at 7. Get me out! I'll take that profit. That's just human nature. That's who we are. So, he says, if you want to be really good at this, you need to accept that everything you do when you're profitable hurts. It feels uncomfortable. If you're in a position and it doesn't feel uncomfortable, you're probably not betting big enough. I want to repeat that. When you're a good trader, everything you do hurts. And I'm not talking about a smack in the hand kind of hurts or a smack in the bottom kind of hurts. If it doesn't feel uncomfortable, you're probably not pressing the position big enough. Here's a snapshot from an open trade. This is equating to being £100,000 in profit. This is not the result of normal thinking. You see, what I'm doing here is the market is trading at 135. 25,135, but my first entry was at 25,458. But as the market falls, I keep adding to my winning position. What do most people do when they are in a winning position? Now, I know the answer because I sat and watched this for 10 years. When you're in a winning position, what do? Take half profit, nip a little bit more, move the stop loss down so it is almost meaningless to have a stop loss because you're going to be stopped out by the slightest movement in the other direction. People are great at taking half profits. They're just not great at taking half losses. We love to take a bit of a profit home because it feels good. It feels like we're doing the right thing. Why on earth would I risk losing some of my open profits? You can't go broke taking a profit. That's what the books are telling me. Now, the amount of time that I have had 10 or 20,000 pound open profit positions, that will then turn into a zero, a countless. My trading philosophy, ladies and gentlemen, is that I will never get out at the maximum profit potential, ever.
But to really understand how he operates, you need to see the inversion of logic that drives his trading. Where most traders see danger, he sees confirmation. Where most would take profit, he doubles down. Here's what that mindset looks like in action.
People are fearful when they're hopeful, and they are hopeful when they should be fearful. What do I mean by that? Imagine that you are sat in a position that is making you the aforementioned £1,000. You're no longer hoping that that £1,000 is going to turn into £2,000 or £3,000. No, you're fearful that £1,000 is going to be taken from you. And if you are losing £1,000, you're most likely going to sit there and thinking, wouldn't it be great if this position turned around? You're not fearful that that position is going to get even worse. You're hopeful that it's going to turn around. And if you want to have a fighting chance of making the markets your ATM machine, and this is not a sales pitch, it's a bit of a cliche, I admit that, but if you want to have a fighting chance of making the markets the place where you take money out on a fairly regular basis, you need to turn this around. So let's take a look at not so normal and people who are what we call the 1%. Rather than talking about me, which is something I'm not that good at doing, I prefer to throw the attention some truly great traders. One in particular is someone who I wish I could have met, but he's no longer with us. His name was Charlie D. Here he says, the time you know you've become a good trader is that day you're able to win by holding on to a winning position. And rather than taking half profits, you're adding to your winning position. Rather than beginning to think, where should I get out? You're beginning to think, how can I get deeper in? How can I commit more? He says, there are many people in here, in the pit, that have traded for a long time, who have never added to a winning position. Have any of you ever added to a losing trade? Sure we have. Oh, of course we've added. You know, you bought at 20 and then it goes down to 10. You're thinking, it looked good at 20. It looks even better at 10. But how many of us have bought at 20 and then bought more at 30 and bought more at 40 and bought more at 50? Sure, there will be people who have done it and good on you. But it's very difficult emotionally to add to a winning trade. It's a lot easier to add to a losing trade because, hey, you feel like you're getting a bargain. You feel like you're buying something which is cheap. And hey, when we started learning about trading, what were we told? We were told, buy low and sell high. Quite possibly the most expensive piece of advice ever dished out in the history of mankind. Because every single time I bought low, it always went lower. And every single time I tried to short high, it always seemed to know that I was in and it would go even higher.
Most traders think their biggest enemy is the market. But in Tom's view, the real opponent is internal. Your own instincts, emotions, and impulses. And after watching thousands of trades unfold, he knows exactly what that looks like.
I want to hold up a mirror, ladies and gentlemen. I want to show you who you really are. Not being personal, but based on the experiences of a guy who spent every single day from 7 a.m. until 9 p.m. watching you trade. maybe not you personally, but you as a whole. 12, 14 hours every single trading day for a decade, watching your mistakes, watching you sitting there, hoping, praying that your position is going to turn around, moving your stop loss further away so you don't get stopped out, cutting your profits so soon because, hey, who can go broke taking a profit? Yeah, you did. You managed to go broke over and over because you're always snapping at the profit because you didn't understand fear. You didn't understand what was going on in your minds. And I'm not belittling you, and now I am not talking down to you. I am genuinely trying to make you see trading from a very different perspective than you perhaps have addressed it from before.
Fear shows up in every trader, not always as panic, but as hesitation, second-guessing, or the urge to protect small profits. And Tom has spent years studying those patterns, not in theory, but in real time, watching them unfold minute by minute. But what happens when you strip out the noise and follow a plan? No matter how uncomfortable it feels, that's exactly what this next story illustrates.
He had a dispute with one of his colleagues called William Eckert. William Eckert, he's a professor in mathematics, brilliant trader, brilliant mind. And they had this bet. Trading? No, you're born a trader. You can't teach trading. No, you're born a trader, you're not a trader. And I don't know which one of them said, no, it can be taught. They said, right, let's bet. Let's find out. Let's hire some traders and settle this bet once and for all. We are going to get some people in. We're going to train them in our money management and our entry techniques. And the techniques they had, they were very complicated, extremely complicated. That's sarcasm, by the way. Their entry technique was, if the market trades at its highest for the last 20 days, then that's your buy signal. I.e., if the market sits at its highest for the last 20 days, buy. And if the market sits at its lowest for the last 20 days, sell short. So they got the 10 people in, and I happened to get to know one of them. Russell was a world-class backgammon player, and that's why he got hired. Richard and William Eckert, they thought, well, guys like that, they will know statistics, they'll know odds. And I happened to get to know Russell when he was in London. And he said, do you know what the worst thing about being a turtle trader was? It was that you were not allowed to take your profit. You could be long soybeans or wheat, and it would be climbing, climbing, and climbing, and climbing. And you would be making $1 million, $2 million, $10 million, $20 million, $30 million, but you were not allowed to guess where the top was. And it was unbearable. You sat there, and that money was burning a hole in your pocket. You were just not allowed, because what Richard Danish advocated was that out of 100 trades you execute, 97 of them are going to be, nah. But 3 of them are going to be ka-ching. And you never know which one of the hundreds it is. So you just had to sit on your hands. And I swear to you, he says, the hardest thing in the world is to sit on your hands and just let the market do what the market does. And in the end, he bowed out. He just couldn't hack that way of trading anymore. Now, would you agree with me that there was nothing on paper, there was nothing difficult about the entry system. There was nothing difficult about adding to the winning positions. They had a mathematical formula. It's efficient. It's just very difficult to do nothing in the face of a winning position. Or you want to tinker a little bit with it, or maybe take a little bit of profit. But leaving a winning position alone, that's why trading is difficult. It's not difficult to understand Fibonacci and stochastics and all these things. No, fighting our natural urges is what makes trading difficult.
So that was the story of the turtle traders. A real-world experiment that proved discipline beats talent. The system was simple. The hard part? Doing nothing while profits grew. That's the real challenge in trading. Not strategy, but self-control. As Tom put it, the hardest part isn't the chart. It's sitting still when the money's already yours. Now let's flip the script. While most traders shrink after a win, Tom Hougaard does the opposite. Up next, you'll hear why he presses harder when he's ahead and how thinking like the top 10% means leaning into discomfort when it matters most. Let's dive in.
You know that the vast majority of people, when they make money, they'll have a tendency to reduce their trading size because they want to avoid the pain of losing some of their gains. And I swear to God, 99% of the trading population just doesn't get it. When I win, I don't bet less. I bet more. The more I win, the higher I bet. See, you can think of this in two ways. You can say, well, I like to think like the 10%, or you can turn it on its head and say, I'd like to not think like the 90%. And so you almost can do a self-analysis and say, well, how is it that I tend to think? And it doesn't matter whether you trade currencies or commodities. It doesn't matter whether you're a scalper, an intraday trader, or an investor. I participate in a radio program in Denmark where we're each year given 250,000 Danish kroner, which is roughly 25,000 pounds. And our job, there's 3 of us, our job is to grow that money to as much as we can. And we get to keep the spoils, but if we lose, well, then the competition, the people who run the competition, they're the one that takes the loss. It's a rather favorable setup. Some would even say there's an element of moral hazard in there. However, I see it slightly differently. I see it is when I trade in this competition, which I've won 4 years out of 5, and the year that I lost was actually this year, is that when I'm in a position, I don't sit and congratulate myself that it's going well. If I am in a position, be it in some share, and there we're always trading physical shares or ETFs. If I'm in a winning position, I don't sit and congratulate myself. No, I want to get that position bigger and bigger. And yes, there have been many times when I've been in a position and it's going well, and then the market takes an unexpected turn, as it does, and all of a sudden this winning position of 5,000 pounds, because we're not trading with leverage, so it's relatively small amounts. So the years that I've won it, it's because I've grown the account by 10, 15, 20%. So we're not talking about 200% gains in a year, but it's because I have compounded my positions. So when I am in a winning position, I don't think like the 90%. I don't sit there and think, when should I get out? When should I get out? Ooh, it's getting, oh, did you see that? The market just turned down a little bit. I better get out now. No, I keep thinking, how the hell can I press this position so I can make even more?
That mindset to press harder when others pull back is what creates real momentum. Not just in account size, but in confidence and decision-making. But even with all that experience, Tom never forgets the danger of trading emotional patterns, especially when they feel like bargains. Here's a story that changed the way he sees value, and why cheap in markets can be a trap.
I want to tell you a story that truly changed me as a person. When I worked at City Index, no one cared about Northern Rock. It had a base around 600 for a long time. And then in late 2005, it was as if it went on fire. From 700 to 1,300, that's 80, 90%. But do you think that any of the City Index clients were on board this? No, they weren't. But it gets interesting because Northern Rock peaked, did a double top, and then fell back. And then the curious things happened. No one had been interested in Northern Rock, but now they became interested in it. All of a sudden, people began to buy Northern Rock. Now, a broker doesn't ask a client, why do you buy Northern Rock? But they did. Now, my thinking is that they thought that Northern Rock had become cheap. I call it the supermarket mentality. And the supermarket mentality is a mentality that you see in investors, traders, scalpers, and anything in between. It is universal. We all suffer from it. And I'm okay with it when I'm down in the supermarket. Quite all right. By all means, buy 2 chickens for the price of 1 chicken, or load up on butter ahead of Christmas, please, when it's on offer. Sadly, the financial market is a very different proposition. And what really affected me was a phone call that I received after that long thing there. It was Saturday morning, and someone called me and said, hey, you gave a talk up here up north, and I just wondered if I could have your opinion. My brother and I want to invest in Northern Rock, because we think that it's a fantastic stock and it's probably a rare opportunity that is so cheap. What do you think about that? And I said, well, I'm not so sure it's a good idea, and there's 2 reasons for that. 1, supermarket aside, that mentality doesn't work in the financial market. And secondly, let's say you do buy it here and it miraculously does turn around. You now forged a pathway in your mind that says, hey, next time a really good stock comes along and it's fallen 66% from its peak, now might be a good time to buy as well. And you might get away with the first time, you might get away with the second time, but overall, you are playing Russian roulette. and sooner or later, you are going to get your head handed on a silver platter. Thank you very much.
So now that you've seen how Tom Hougaard approaches the market with intensity, discipline, and brutal honesty, it's time to turn those lessons into something practical. Here's a simple breakdown to guide your next trading session. First, prepare with purpose. Tom doesn't wing it. He builds scenarios in advance based on patterns and probabilities. Treat preparation like a daily ritual, not a checkbox. Second, embrace discomfort. If holding a winner feels easy, you're probably not pressing it hard enough. The best trades hurt, not because they're wrong, but because they stretch your limits. Third, scale when you're strong. Most traders pull back after a win. Tom pushes forward. He compounds confidence with size, not recklessly, but with intent. Fourth, ignore the bargain trap. Just because a stock is cheap doesn't mean it's a deal. The market isn't a supermarket. Price without context is a recipe for pain. And finally, simplify to amplify. Trading isn't about doing more, it's about knowing when not to act. The sharpest decisions come from stillness, not from the noise of constant activity. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.